Milton, thank you for the introduction, and I don't know if Sharon's here, but thanks for the opportunity to speak. I must admit I like the music and flashing lights for something as exciting as currency derivative conversation, 4 o'clock on the last day of the conference. So thank you all for your attention. As Milton mentioned, we do advise about 1,000 clients globally. The volume is around 400 billion US. Just to say that there is credibility in that in terms of volume, but actually it's a one-on-one type of interaction. So I appreciate the opportunity to speak to a broader group. I do love risk. I believe in managing risk and the message we have today. The commentary today is largely from the perspective of our advisory practice to funds, but anyone with currency risk should, in my view, think this way. Again, the topic is a bit dry, so I thought of reworking the slides to kind of liven it up, but I don't think I can compete with Mr. Ronnie Chan's style yesterday, although he did provide some sound bites that I can weave in today. One of which is Chatham does fall in the financial services industry category. I hope that's okay. We really do serve. To set the scope for this talk, if you have local currency investments where it's renminbi to renminbi or offshore debt that you never plan to repay, or of course use 100% leverage and reinvest it forever, this isn't for you. This is for currency risk, so feel free to leave. Okay, I think with that, it looks like it resonates, and let's sort of get into it. Let's check this. So this is a chart that you're all probably seen. Simply just points to the fact that cross-border capital flows are quite large. This is just from the first quarter. And this is more than just data to many of you, be it GPs or LPs. This is really top of the mind. Currency volatility, currency fluctuation is a topic that comes up in conversation, both in and out of the office. From my firm, it's an ever-increasing conversation, both with GPs but also with the LPs, either indirectly or directly. Just last week, the Asia CFO of a large fund contacted me in a bit of a panic, trying to answer a very simple question. What is our equity exposure in our Asia book? And that question was coming from the headquarters. So again, it's top of mind. Also, Mr. Chan's comment yesterday, quote, financial market volatility is here to stay. I prepared these slides before his presentation, and I did present it in the form of a question, but clearly he gave us that answer. If looking at the chart, I mean, charts are great. You can see the spike around the GFC, and these are some of the main currencies in Asia. Even though volatility has certainly come off since the GFC, if you look in kind of late 2006, where you're talking about a 5 or 8% fluctuation versus a 15% fluctuation now, it's still a very important point. So if you tie this volatility with the global flows, clearly it's on the mind. And then more specific to property, I think the interesting fact is property investing, with a few exceptions, is rather straightforward. You acquire an asset that generates income or capital appreciation, ideally both. And clearly, when those proceeds are brought back to your home currency, the currency exchange rate can impact the math. Similar to, I think everything so far is pretty intuitive. Currencies are volatile, cross-border investments are common, and it can impact the returns. Ironically, the debate, if you will, around what to do about that is quite wide. In our world, again, currency risk is a straightforward idea, and particularly in real estate, but I think we should look at an example. And this graphic might be familiar to many of you. Essentially, it's a graphic of fund flows. So you go through an underwriting process, you evaluate the debt and equity to purchase an asset in China, you hold the asset, it generates income, and at some stage the asset's sold, and the proceeds are used to repay debt and, of course, equity and profit. So looking at some of the risks specifically, that we could sort of break it out into categories, The first is a closing risk. Again, in this particular case, and this is an example I think that is more common, given some of the offshore, generally there's a small onshore debt instrument in China to put a mortgage on, and then a large portion is funded offshore. And currently, Singaporean banks are highly capitalized, so you may have a situation where the debt is denominated in a currency other than the investment. If, in this case, renminbi appreciates, and the Singapore dollar amount is a fixed commitment, what happens? You have to top up equity. So that's what we mean by closing risk. Income risk is straightforward. The risk that renminbi depreciates during the whole period. The big one is equity risk. Clearly in today's market where debt capital funding is challenged, loan to values are coming down, and you may find yourselves with 50% or more equity in an investment. This is a significant risk. This is the one that tends to be top of mind, particularly because it's longer term. And then, of course, profit when you do your job. Looking at debt covenant risk and principal repayment. So in our view, there's several risks when you think about currency risk to real estate, and this is how we look to kind of break those out. So again, I think this resonates with everyone. It makes maybe you're thinking, yeah, this is consistent with some of the things we wrestle with. It's helpful that it's kind of broke out into these different categories, but what do we do about it? Again, it's intuitive. This seems straightforward. But the debate internally tends to roar on about what do we do about currency risk. Whether the GP or its LPs have differing views on currency hedging and it influences the decision. They may look and say, well, we have a view that the currency is going to do. There's a variety of noise in our view that comes into play. So we do believe there's a best practice for property investors to hedge the currency, and we'll work into that topic shortly. One of the kind of side conversations that comes up, I tend to break it into skeptics of hedging versus people who hedge. It tends to be driven really by, well, I guess just to take it, well, we can look at this. So anecdotally, looking at the PERE 30, which is ostensibly a decent measure of the industry, as far as I can tell, every one of those companies uses currency derivatives to some degree. And although hedges are routinely used, you have to be careful to interpret the occasional use as best practice. Depending on the size and the complexity of the portfolio, patchy hedge use, it can actually introduce risk. The issue is you can alter currency correlations, which is a bit of a technical issue, but the point is hedging should not be a hobby. Secondly, we do observe the unfortunate fact that hedges are used poorly. They're implemented in an inappropriate way. Now, some of the themes we've heard, or at least I heard throughout the conference, was defense versus offense. Some asset classes are defense, some asset classes are offensive. Similarly, derivatives are the same thing. They can be used to play offense. You can make a leveraged bet on a currency, or you can use derivatives to play defense. And I think this is really some of the underlying challenges I think that myself as a hedging advisor run into. So for those of you that don't hedge, I'm sorry about the micro font, but what it says is it because of a deliberate, well-intentioned plan not to hedge? Or is it kind of a knee-jerk reaction to a story or something in the FT or a friend of a friend that experienced a blow up? And some of those misconceptions I would package in these. I'll give you a second. So again, looking at using the offense and defense analogy, a lot of these statements tend to be, the story behind the story is maybe a leveraged bet, a situation where a hedge was used and then the underlying equity, unfortunately, had eroded, but the hedge stayed in place. I think the critical point is, investing in property and isolating risk is a different decision than investing in currency. Now, intuitively, that strikes a chord, and a lot of people say we're we're real estate investors and not currency investors. But the unfortunate fact is both sporadic use and misuse ends up being the story behind the story. So now that kind of drama's out of the way, and certainly not trying to defend the industry or OTC derivatives in general, but I think looking at those that do hedge, what we perceive in that case is, again, two broad categories. It's this deal-by-deal mentality versus what we advocate, which is a holistic approach. I know that it's a very sort of consulting word, but I'll put some practical legs under it. So you probably know folks like this in your organization that say, we only hedge with a certain product. This deal team does it this way, this deal team does it that way. Someone else that says, let's just get the deal closed. Let's close the deal, get it in the books. At some point, somebody will worry about the risk in the portfolio, but we don't focus on the hedging right now. And then there are others that simply say we don't hedge. And again, tying it back to the previous discussion, is it because of a well-developed decision, or is it based on what I would classify as misconceptions? Now, kind of contrast this to what we use the term holistic approach. What we're talking about here is a shift in thinking from deal teams do whatever they want to a situation where in this case the GP explicitly and intentionally has access to expertise around risk management, the processes to make that as efficient and robust as possible, and if needed, technology that can support it. This is an engagement I'm working on right now where a large global manager at kind of the executive level, in the C-suite, is asking a lot of big picture questions about the business, about the risk to the business, whether it's a Eurozone collapse or covenant, loan covenant compliance, and financial risk, right? Be it currency risk in this case or also interest rate risk. And really what he's saying is, I'm not comfortable that my organization has the competencies and the policies and the procedures and the systems necessary. Again, that's very different than sort of tribal deal team mentality where everyone does what they do. At some stage, at some point in most of the companies we talk to, this is a big issue. So looking at each of these, again, to try to be as practical as possible. Let's get to the biggest one is this issue of having a policy. To me, it's a gaping hole in the industry, the absence of a policy. Again, it's simple to put together. There's a few parameters that we would recommend. We can provide templates and not to pitch. I mean, there's nothing overly complicated or sexy about a hedge policy. It's the absence of it that I think is pretty shocking. But the knowledge is within the company, and bringing that together is critical. Both the identifying and quantifying the exposures and also to some degree underwriting require expertise, access to expertise and market knowledge about critically understanding these issues. I mean, do you have the expertise in your organization? Is there an investment in the data to be able to really feel comfortable in those forecasts? And do you know who in the organization is looking after these things? I mean, those are the questions that come up. Underwriting, you think, well, that's not really a hedging issue. And we would actually argue the exact opposite. Just as you go through the process of underwriting the cost of a tax structure or on-site due diligence inspection, I mean, those wouldn't be things that you say, well, that's too expensive. We don't want to underwrite the cost of the tax structure or cost of capital in general. I strongly believe this is a time to underwrite the cost of hedging. That's not necessarily advocating hedging. The decision comes later whether or not to hedge, but certainly include it in the process. Counterparty management is just speaking to, we are an advisory firm. We're not running a book or taking a principal position, and ultimately banks are needed to provide the products. And that's the point, is the derivatives hedge instruments are standalone financial contracts. They're not just part of the package that gets bundled up. And I think it's important to be treated that way. At the fund level, if hedging at the fund level, this is a bit intuitive. Counsel may ask about the obligation, the legal or the credit, or of course the economic obligation that's being created. It's also happening at the asset level. And that's something that needs to be determined long before the hedge takes place. And then we get to it, which is what exactly are we going to do? Firstly, this should tie back to the policy. I mean, the policy shouldn't be so prescriptive that nobody pays attention to it. If it says when we invest in Malaysia, these are the 10 things we do and this is who we trade with, that's not practical. The policy has guidelines that should be used to determine the hedge strategy. But again, a caution, this is a conversation we see over and over again where the debate internally, especially with real estate investors, is it goes from how do we remove the currency risk to how can we win? What derivative gives us the biggest payoff? And that's where the problems start. So it's subtle. It tends to feel the same, but there is a big difference, and certainly be on the lookout for that. Now, having said that, this isn't a set it and forget it type of process. So take, for example, we work with a lot of offshore investors in Japan. That's a currency that's generally performed quite well given its safe haven perception. And the policy stated that, in this particular case, that the fund was not to put more than 10% of its invested equity at risk. Right? So if you go back to that grid, it was the equity component. And to limit their risk to 10% loss of currency is basically they bought some insurance, but they monitored the currency. And as the yen appreciated against the dollar in this case, their home currency, they readdressed their hedge policy and started to lock in some of that, which is IRR accretive. This isn't to say that, again, currency should be a way to make money and improve returns. The point is that, and I just want to drive this home, the first thing they did was remove the risk, consistent with the policy, by buying that protection. But as the currency moved, they took the opportunity to lock in some of that. Obviously, the larger the group gets, the more diverse it is. This admittedly looks like a lot, and it can take time and energy to implement. But we just believe in the long run, it's the only way to have a circumspect, clear, and robust solution to currency risks, to real estate. Now, admittedly, this still probably looks a bit academic. I'm trying to put in some anecdotes, but let's tie it back to this situation and talk through a little bit what we see. Again, the underwriting process, the risk we're talking about here is you're looking at an asset, in this case in China, and it's a contingent risk. So until an SPA or some sort of economic obligation is created, it's just something to keep an eye on. But once the SPA is closed, there is a real risk of needing more dollars. We rarely see this hedged. The two main situations where this does happen is, firstly, the fund may be at the end of its life, or for whatever reason, maybe it's a separate account and there's a finite amount of dollars available. That's a risk. That's a risk to closing. If renminbi appreciates significantly, and in this case the offshore Singapore dollar debt is fixed, then more dollars are needed. We will see people hedge that. Secondly, and again, this should all be discussed in the policy. Secondly is the situation perhaps with Indian rupee, which is historically quite weak, and you sign an SPA and you have 5 weeks to deliver. We have had clients that have locked in that cost because they took a view based on the absolute level of rates that the currency was weak. But again, just to talk about what we see. This one's a bit of an easier break. For opportunistic returns, typically those assets are not, income-producing assets don't present the opportunity for opportunistic returns, so it tends not to be a big issue. However, for dividend products, core products, even core plus that are marketed as income products, this is a big deal, and we do see people hedge that with that profile. This is the big one. It's I wonder if that can. Yeah. So what it says there is the vast majority of the interactions we have is taking the risk on 1 times of the equity and trying to hedge that. Now this just came up this week where we got a call from an investor in India, and they said a U.S. dollar fund, and they sent us their book, their investment book with where they got in the assets, what their current anticipated exit price in local currency would be, and their weighted average investment rate was around 44. They were brilliant investments. They've done extremely well, but with rupee at 54, that's a different situation in dollar terms. Now, that's not to sell fear at all. It's just to make the point that equity risk is present and it's significant and it can impact the returns. Similar to kind of the income risk is, again, if you have offshore debt and covenants based in the offshore currency, there is risk to servicing the P&I and passing, whether it's an ICR, DSCR, whatever the test is, in this case in Singapore dollars. And that's something that if the lender doesn't require it, for those of you investing in China, I guess in 07, 08, and 09, cross-currency swaps were the product du jour, which were to say you can borrow onshore against PBOC at 8%, or you can borrow offshore at a 3% renminbi rate. Well, all it was doing was converting using the currency and converting those cash flows back to a fixed renminbi rate. That, by the way, that deal is pretty much gone from the market now because of the way the currencies have moved, but that may be in your memory about what the lenders were requiring at certain times. And similarly, the balloon, the debt repayment. There is risk of currency depreciating against your ability to repay the debt. I guess lastly is profit. This comes up more often than not because you're good at what you do and you make money and you have profits. Our view on this is not to hedge it. And if it is hedged with an instrument that doesn't create a massive additional risk. In other words, sort of plainly put, the profit that you're forecasting is a forecasted profit. And if things change and you have a hedge, you can have good news. You can have bad news, which is your profit has moved lower, and the hedge is now a liability. So unless there is a known cash flow, again, a signed SPA, some certainty around the realization of that profit, even though it is part of the forecast, we would not recommend hedging it. People do, but that's just a point of debate. So in summary, we saw that currency volatility is high. So I think it's a relevant point. It's, according to Mr. Chan, it's not going away. Currency risk is present in your deals, but not in necessarily the same way in every deal. There's a number of situations where it's present. Currency hedging takes place. It's a hobby. People tend to dabble, but again, that inconsistently isn't necessarily a best practice. And again, the misconceptions that are out there, we do see that result in, as we say, kind of misguided or the wrong decisions, and it's generally sporadic use or misuse underneath a lot of those misconceptions. We do believe in a holistic approach. I think I made that point clear, but it can transform and should transform the way your business can manage currency risk. We do believe in a best-in-class program that is holistic. We talked to that. Policy-based, again, this is a huge observation from my view, missing in the market. Centralized and to the degree possible to create that consistency. And again, this is a This is difficult for global managers to do. I recognize that. We ourselves have multiple offices, and even being consistent within advisory is challenging, but it is a better way than, again, the sort of deal teams do what they want. And again, dynamic. And this sounds a little bit exciting, and that's not the point. The point is allowing for market movements, for opportunities that occur, can really help. It may increase returns, but for sure creates consistency, which I think is the point. They need access to the expertise. These markets, particularly in Asia, where you have multiple sovereign regulatory impacts to how currencies work. Is it onshore? Is it offshore? Is it fully convertible, partially convertible? What are the various regulations? You need access to that expertise to properly get into hedging. And then I guess just in closing, we will have a few minutes for questions, and I understand that hasn't been a popular event. The deal by deal isn't necessarily deal by deal versus holistic. We're saying it is both, but it starts with a holistic approach that informs and essentially legislates what the deal team should be doing. That's taken in the context of a broader strategy. And again, it's not about how do I win or lose on a particular hedge. Now, I do recognize that there is pressure or predisposition from senior management, from your investors, or as an investor. Product providers have their recommendations. Economists have forecasts. There's a lot of internal history. This does muddy the decision. I recognize that. However, I do strongly believe that if you're taking a holistic approach, and that is a function of, again, expertise and process and technology, it will result over the long run with better decisions, better execution, less fire drills, more certainty, more efficiency, and ultimately reduced risk. So that's it for me. I appreciate everyone's attention and again, recognize the topic and the time of day, but I do very much believe in this, and I appreciate the time to bring this. Thank you for your time.